Welcome to meeting number 24 of the House of Commons Standing Committee on Finance. Pursuant to the motion adopted in committee on January 12, 2022, the committee is meeting on the inflation in the current Canadian economy. Today's meeting is taking place in a hybrid format pursuant to the House Order of November 25, 2021. Members are attending in person in the room and remotely using the Zoom application. The proceedings will be made available via the House of Commons website, so you're aware the webcast will always show the person speaking rather than the entirety of the committee. Today's meeting is also taking place in the webinar format. Webinars are for public committee meetings and are available only to members, their staff, and witnesses. Members enter immediately as active participants. All functionalities for active participants remain the same. Staff will be non-active participants and can therefore only view the meeting in gallery view. I'd like to take this opportunity to remind all participants to this meeting that screenshots or taking photos of your screen is not permitted. Given the ongoing pandemic situation and in light of the recommendations from the health authorities, as well as the directive of the Board of the Internal Economy on October 19, 2021, to remain healthy and safe, all those attending the meeting in person are to maintain a 2-meter physical distancing, must wear a non-medical mask when circulating in the room, and it is highly recommended that the mask be worn at all times, including when seated. Must maintain proper hand hygiene by using the provided hand sanitizer at the room entrance. As the chair, I'll be enforcing these measures for the duration of the meeting, and I'll thank members in advance for their cooperation. To ensure an orderly meeting, I'd like to outline a few rules to follow. Members and witnesses may speak in the official language of their choice. Interpretation services are available for this meeting. You have the choice at the bottom of your screen of either floor, English, or French. If interpretation is lost, please inform me immediately, and we will ensure interpretation is properly restored before resuming the proceedings. The raise hand feature at the bottom of the screen can be used at any time if you wish to speak or alert the chair. For members participating in person, proceed as you usually would when the whole committee is meeting in person in a committee room. Keep in mind the Board of Internal Economy's guidelines for mask use and health protocols. Before speaking, please wait until I recognize you by name. If you are on the video conference, please click on the microphone icon to unmute yourself. Those in the room, your microphone will be controlled as normal by the Proceedings and Verification Officer. When speaking, please speak slowly and clearly. When you're not speaking, your mic should be on mute. A reminder that all comments by members and witnesses should be addressed through the chair. With regard to a speaking list, the committee clerk and I will do our best to maintain a consolidated order of speaking for all members, whether they are participating virtually or in person. The committee agreed that during these hearings, the chair enforces the rule that the response by a witness to a question take no longer than the time taken to ask the question. That being said, I request that members and witnesses mutually treat each other with respect and decorum. If you think the witness has gone beyond the time, it is the member's prerogative to interrupt or ask the next question, and to be mindful of other members' time allocation during the meeting. I also request that members not go much over their allotted question time. Though we will not interrupt during a member's allotted time, I'd like to keep you informed that our clerk has 2 clocks to time our members and witnesses. I'd now like to welcome today's witnesses. From the Bank of Canada, we have with us Governor Tiff Macklem, welcome, and also Senior Deputy Governor Carolyn Rogers. I'd also like to convey my sincere thanks to the Governor and Senior Deputy Governor. We do understand this has been an extremely busy time for you. And on behalf of the Standing Committee on Finance and its members, we want to thank you for honoring our request to come before our committee. Governor, the floor is yours for opening remarks.
Well, merci. Bonjour et merci de m'avoir invité à participer à votre étude sur l'inflation dans l'économie canadienne.
Thank you for inviting me here as part of your study on inflation in Canada. I'm pleased to have Senior Deputy Governor Carolyn Rogers with me for her first appearance before this committee.
Since I was last here, the Bank of Canada and the Government of Canada renewed our joint agreement on Canada's monetary policy framework. We agreed that the primary objective of monetary policy is price stability. Under the 2022-26 agreement, the cornerstone of our framework remains the 2% inflation target at the midpoint of a 1% to 3% control range. And earlier today, I spoke to the CFA Society where I explained our policy decision yesterday to raise our policy interest rate by 25 basis points to 0.5%. I also reviewed the drivers of the recent rise in inflation globally and here in Canada. I know this is directly relevant to your study, so I've given my remarks to the clerk to share with committee members. I look forward to exploring these issues with you today. Before moving to your questions, I'd like to talk to you and Canadians about three things. First, I'd like to review the Bank of Canada's actions over the course of the pandemic. What we were trying to achieve, what happened, and what would have happened if we hadn't acted. Second, I want to speak to the concerns many Canadians have about the rising cost of living. I know many people are worried about prices at the gas pump, cost at the grocery store. They're worried about housing affordability, how to save enough for retirement. And that angst has been compounded by everything we've gone through these past 2 years through this pandemic. Third, I want to talk about what's next. This latest wave of the pandemic is fading, and life is starting to return to normal, a new normal. I want to share what Canadians can expect to see in the economy, with inflation, and from the Bank of Canada. At the outset of the pandemic, uncertainty skyrocketed, financial markets seized up, and economic activity fell off a cliff. About 3 million Canadians lost their jobs, and more than 3 million people were working less than half their normal hours. Businesses closed up shop in record numbers. Inflation fell sharply, even dropping into negative numbers. We were staring down another Great Depression and the possibility of deflation. Deflation happens when prices across the economy actually fall. Now, this might not sound so bad, but the truth is that persistent deflation is dangerous. Quand le chômage augmente rapidement et que tous les
When unemployment rises rapidly and prices fall, households may be inclined to cut back on spending if they think that goods and services will become even cheaper in future. But deferring spending has consequences. Demand drops, causing more job losses and business closures. All this adds to downward pressure not only on prices, but also on wages. Prices and wages can enter a downward spiral, as they did in Canada during the Great Depression. In such a deflationary environment, debt payments are also more expensive, which could have been a real problem for a country such as Canada, where households are highly indebted. So when the pandemic started and we were facing an economic catastrophe, we took exceptional measures. We took the policy interest rate to the lowest possible level. We promised not to raise interest rates until the economy's excess capacity had been fully absorbed. And we buttressed this commitment with quantitative easing. Together, these measures have kept borrowing rates low to stimulate spending and create much-needed confidence in the economy so that businesses and households as well can recover.
Resilience of Canadians, effective vaccines, exceptional fiscal policy, and the bank's actions, Canada avoided deflation and our economy has recovered. But I recognize that this reassurance may not reflect how many are feeling. Even before the pandemic, many Canadians were worried about how they were faring economically. Not everyone was experiencing the benefits of a growing economy and a healthy labor market. The pandemic intensified people's concerns, layering worries about their health, that of their loved ones, on top of uncertainty about jobs and businesses, the value of their savings, and the prospects for retirement. Reopening the economy has brought new complications, leading to higher inflation around the world and here at home. The COVID-19 virus continues to circulate and mutate. We're seeing social upheaval here in Canada and in other countries. And in the last week, shocking developments have unfolded in Ukraine at great human cost. The unprovoked Russian invasion is creating volatility and uncertainty in the global economy. We are living in anxious times. Needless to say, monetary policy is not equipped to address most of these issues, but it is equipped and mandated to control inflation. Here in Canada, inflation is just above 5%. That's too high. And with oil prices rising further in recent weeks, we can expect inflation to move up again. I'm sure people are wondering why prices are so high. So let's unpack it. The inflation story in Canada has three key elements. The first is that through the pandemic, many people shifted to buying more goods and fewer services. At the same time, the pandemic disrupted the production and delivery of many items. This caused the prices of many globally traded goods to rise sharply. The second is that price increases have seeped into an increasingly wide array of goods, including everyday items like food and energy. Oil prices are higher because of strong demand, limited investment in new production, and geopolitical tensions. This means higher transportation costs, which further add to the prices of goods. Food prices are also being affected by extreme weather that has reduced harvests, and strong demand for housing in the face of limited supply has pushed those prices up. Le troisième phénomène concerne
The third phenomena concerns the strength of the recovery in Canada and the overall balance between demand and supply in our economy. Current inflation is not due to excess demand in the economy. A range of indicators suggest that excess capacity in the economy has now been absorbed. This means that going forward, spending growth will have to slow down so that demand does not outstrip supply and create a new source of inflation in Canada. So we need to tighten our monetary policy, or to put it simply, raise interest rates to keep inflation under control.
Let me wrap up by explaining what Canadians can expect from us going forward. Monetary policy has a clear role to play in keeping supply and demand in balance and getting inflation back to target. To this end, we have taken deliberate steps to adjust the degree of monetary policy stimulus as the economy has recovered. We slowed our quantitative easing and we stopped it outright last October. And we made it clear to Canadians in January that with the economy operating at capacity, our guarantee of rock bottom rates had ended. We need higher interest rates to bring inflation sustainably back down and keep the economy in balance. Yesterday, the Governing Council took the decision to raise the policy interest rate by 25 basis points to 0.5%. We indicated that we expect interest rates will need to rise further. We also said that we will be considering when to end the reinvestment phase of our large-scale asset purchases and allow the bank's holdings of Government of Canada bonds to begin to shrink. This is a process known as quantitative tightening, or QT. The timing and pace of further increases in the policy rate and the start of QT will be guided by the bank's ongoing assessment of the economy and its commitment to achieving the 2% inflation target. In closing, I want to emphasize to all Canadians that the bank is determined to control inflation. With that, Senior Deputy Governor Rogers and I would be very pleased to answer your questions.
Thank you. Thank you, Governor, for your opening remarks. We are going to be moving to our first round of questions from members. In this round, each party will have up to 6 minutes for questioning the Governor and Senior Deputy Governor. And we are starting with the Conservatives, and Mr. Chambers is up for 6 minutes.
Thank you very much, Mr. Chair, and welcome, Governor, Senior Deputy Governor. Nice to have you here for the first time. This is a very important study for us, and we very much value the bank's view on these issues. Inflation is affecting the everyday lives of Canadians. Governor, it's the first time I've seen you since your appointment. Congratulations. Our time will go by fast today, so I'll ask for your cooperation to be as brief in your answers, and I'll try to be as brief in my questions. Governor, in your speech today and also what you've just outlined, you're starting to paint a picture of a different world, at least one that you thought might exist a year ago or even just in October. And if you listen to the finance department today, their worldview seems to diverge. It's a little bit different. The finance department's telling us that the inflation is still temporary and it's beyond the government's control, that the economy needs more investment and stimulus. And we all know that the plan is for some fairly large deficit spending planned in the next budget. And today, you outlined that the risks of inflation are here to stay, they're lingering. We can expect more interest rate hikes to deal with these risks, and that the economy is robust and the slack has been absorbed, which is, operating near capacity. So the question, have you made your views on this now well known to government, and have you warned the Department of Finance of the risks to inflation of continued stimulus and large deficit spending?
Well, we make our views known to all Canadians, and certainly I do actually by mandate have regular discussions with the Minister of Finance, and our staffs do share their outlooks. We do share our outlook with the Department of Finance. With respect to the economy, I think the important point to stress is that the economy has just gotten back to its capacity. It is recovered from the pandemic, and we are seeing considerable momentum. Omicron has certainly dented growth in the first quarter. We lost 200,000 jobs in January. But if you look at indicator, broader set of indicators, it does look like growth in the first quarter is holding up quite well. And as you're well aware, the restrictions are easing. So we do expect to see some increased strength going forward. What all that means is that the economy can handle higher interest rates, and we've been very clear in signaling to Canadians that they should expect a rising path for interest rates.
Well, thank you, and I appreciate that forward-looking guidance. I mean, the question is more around the risks of increased fiscal expansion. We've had testimony from this committee from a number of economists that all have said that increasing government spending and deficit spending will have an upward pressure on inflation. Would you agree with that statement?
I'm going to leave fiscal policy to our elected governments. My job is to control monetary policy. What I can tell you is that we will take the government's fiscal plans into consideration. We will put those in our outlook, and then we will do what we think is necessary to bring inflation back to target.
I understand that may be an uncomfortable question for you, Governor, but it has not prevented your predecessors from sitting in the chair that you're sitting in, telling Canadians that they shouldn't be worried about deficit spending because the economy is operating at under capacity, and we can handle deficit spending. So I guess the flip side now is we're operating at capacity, and the growth is robust. So the question still is, won't additional fiscal policy lead to some higher inflationary pressures? And I mean, you spent some time in the Department of Finance. I know you think about these things. I have great respect for your view on this. I just think the view that you're presenting today and the view that the Department of Finance seems to be diverging.
Look, what I can say is that decisions on what to spend on, what to tax, those are decisions for the elected government to take. Those are decisions for parliamentarians to take. I think when you're considering the impact of government deficits, government spending, you do need to look both at the overall amount and what it's being spent on. And the more that spending creates additional supply in the economy,
I have about a minute left.
The less it's going to cause inflationary pressure. So you need to look both at what the amount and what it's being spent on.
Okay, thank you. The head of OSFI gave an interview where he indicated that house prices could fall up to 20% as interest rates rise. Is that a view shared by the Bank of Canada?
Well, let me talk about the base case and then about the risks around that. So in our base case projection, look, housing activity, as you're well aware, is very elevated. There are a number of reasons for that, which we may have the opportunity to explore.
Are we in a bubble?
In our projection, we expect that housing activity will the growth in housing activity will moderate, but we do expect, and it's built into our projection, that housing activity is going to remain quite strong. Immigration is coming back up, population growth is strong, people have jobs, wages are going up, incomes are healthy. All those things are going to support strength in housing. So we do expect it to moderate, and raising interest rates will be a factor that will help moderate it, but we expect it to gradually diminish.
Thank you.
I think that's my time,
Yeah,
Governor.
that is.
Thank you.
Okay, thank you, MP Chambers. We are moving to the Liberals. MP Chatel for 6 minutes, please.
Merci.
Thank you very much. Mr. Meklem, it's such a pleasure to be here with you and to have you here with us. We know that this is a time when you are kept very busy, so we sincerely thank you for giving us some of your time. I would simply like to go back.
What you said, what was really important when you said that about spending of a government will depend on what we spend on, and at the core, inflation is a result of supply and demand, and if we spend to increase the supply, that relieves the pressure on inflation. So that was a good clarification. Thank you for that. My question to you, Governor, is about the global inflation and the global response to inflation by using monetary policy. One example is I have in front of me the OECD chart on inflation and including the forecast for OECD members. It all followed the same pattern, maybe with some isolated case there. But overall, there's a global phenomenon of inflation. The forecast seems to be a good news in 2002, 2003. But could you please put the inflation in Canada into perspective, into a global perspective?
Yeah, so let me just begin by saying it is a pleasure to be here, and this is yes, we're busy, we're all busy, but this is very important. We're very pleased to be here. So, as you've highlighted, the same factors that have driven inflation up in Canada have driven it up globally. These supply constraints are a global phenomenon. The households shifting out of services into goods because they can't consume a lot of the services they would normally consume during a pandemic is a global phenomenon. And higher energy prices, higher food prices, these goods are all priced in international markets. And so you are seeing very similar inflation dynamics in most countries around the world. In Canada's experience, in some countries, in some advanced countries like the U.S., inflation is a bit higher than it is in the U.S. Some other countries, it's a little lower in France. Canada's experience is not similar to many other countries. But for Canadians, knowing that other people in other countries are facing this inflation, it's a bit of cold comfort. Canadians are still paying higher prices for groceries, higher prices for gasoline, higher prices for many goods, and that's hitting them in the pocketbook. And it is critically important that we bring this inflation back down. We also know that it hits the most vulnerable Canadians the most, those least able to afford it. And that's why we need to raise interest rates. We need to raise interest rates to keep demand and supply in balance, as I discussed. We also need to raise interest rates to keep inflation expectations well anchored. Because when these global supply chains, global supply disruptions, these shipping bottlenecks ease back, Inflation will come back down if we keep inflation expectations well anchored. If we don't, if they become unmoored, it'll be much more difficult to get inflation back down.
Merci beaucoup, Monsieur McLean.
Thank you very much, Mr. Macklem. I have another question about Canada's target, which was set in 1991. We have a very stable policy, a 2% rate, as you have explained, target rate. And of course, monetary policy is oriented by the bank, which operates autonomously, independently, and at arm's length from the government. Can you explain to us how this target, this tool, taken together with other tools that you have authority over, will help us reach inflation targets and how we will reach this target? I've been looking at OCDE forecasts. It looks like things are under control. Do you too feel that everything's under control and that we'll get back to the 2% target? Yes, I am confident that we will. It may take a little time. The tools we have take time before they take effect. It'll take time to slow down the growth in spending and thus bring down inflation. But yes, I'm confident that we'll get there. As you have mentioned, we have experienced inflation since 1991, and since 1995, we have that 2% target. If you look at the average inflation rate in that period, it's around 2%. Over that time, there have been fluctuations, ups and downs in inflation, but we've always gotten back to the 2% inflation rate. What we're seeing now is the highest rate that we've seen since we got going at this, but it's also the first time that we've been through a pandemic, of course, as well. It's a rather unusual situation, so I am confident. Thank you.
Time. I know it goes fast. We are moving to the bloc and MP Sainte-Marie for 6 minutes.
Gouverneur Macklem.
Hello, Governor Macklem and Senior Deputy Governor Rogers. Thank you for being here with us, and thank you for your opening statement at the outset and for answering our questions as well. So we have this inflation problem linked to the pandemic, and you've given us a good explanation of what's gone over the last 2 years. Now we have a new major event, the invasion of Ukraine by Russia. For several economists, including Nouriel Roubini, the paradigm has shifted radically, and stagflation, world stagflation, global stagflation, is a real risk. What do you think of that? The greatest impact of Russia's attack of Ukrainians, and it's very difficult to observe the human cost of the invasion. That's the greatest impact. But as well, this invasion has led to higher uncertainty on the world stage, and the direct link between Canada and Ukraine, the Ukraine or Russia, is actually not that high in terms of the Canadian currency and so on. So there's not that much direct impact on our economy, but there are several indirect effects. In particular, the price of oil, of price at the gas pump. Right now, we're up to $110 for a barrel of U.S. 110 U.S. per barrel, and this will put upward pressure on inflation in Canada and around the world. We also see the prices of agricultural products rising, wheat, for example. So all this can have an effect on the price of what we buy at the grocery store. There's been a lot of volatility in the financial markets, shifting prices of stock, of bonds, of government bonds, and of business-based bonds as well. When fear is rampant, everyone wants American dollars, so that's had an effect on the relative value of the American dollar as well. It's clear that this has had an effect on people's confidence. This is an attack on the global world order. And this is only the second week of this war, so it's difficult to foresee exactly where this will go. But I can tell you that we will take the effects on Canada into account as we make our decisions. So if I may put my question slightly differently, do you fear, as you've said, the first victims of this invasion are the people of Ukraine, and we stand in solidarity with them. We think of them. Do you think that the invasion significantly raises the risk not only of inflation but also of stagflation? And if I may, the economist Robini says that the impact may be higher than what we saw during the two episodes in the 70s. So what do you think? Well, I want to underscore that there are, yes, many uncertainties right now, and it is quite clear that that will have an effect on inflation. And it's not as clear what the effect on growth and GDP will be in Canada. World confidence will be affected, of course. Canada exports many of its products, oil, wheat. So one effect on Canada will be that the revenues we receive, the income we receive for our exports, will be greater. So Canada's income will increase in a way. There are many different effects, you see, and they must all be taken into account. It's difficult to give a full and complete answer at this point. Very good. Thank you very much. In periods of stagflation or, crises of supply, what are the tools that the central bank has to manage that sort of crisis, stagflation? What we have learned during the 1970s, when we did experience stagflation, was that if the inflation forecast, isn't managed, if we have a serious inflation problem, in other words, and the economy is not doing very well, we saw this in the 70s, there were a lot of labor conflicts, strikes. Everyone was upset and worried. Everyone thought that they weren't being sufficiently compensated for the inflation that was affecting them. So what we learned from that period of time is that it's very important to ensure that inflation forecasts are clear. And at that time, we didn't target inflation directly. We tried to target monetary mass growth rates. That didn't work so well. We couldn't seem to stabilize it. So finally, we decided to target inflation itself head on. And that monetary policy framework did work for a good 30 years, and I'm convinced it will continue to work. That's very clear. Thank you very much.
And we are moving to the NDP, and MP Blakey for 6 minutes, please.
Thank you very much, and thank you for your appearance here today. One of the things we've heard a lot of discussion about around this table since the election has been the role of quantitative easing in affecting prices in the housing market. And there have been some around this table that have claimed that the quantitative easing program has been primarily responsible for the growth of prices in the housing market, or for their exceptional rate of increase, almost doubling over the last 2 years. So very glad to have you here. I'm wondering if you would like to speak to the bank's own understanding of the role of quantitative easing in the housing market over the last 2 years, and the extent to which it may have contributed to increases in the price of housing overall.
Yes, I'm very pleased to answer that question. So, the reason we've seen strong mortgage growth in Canada is that Canadians want more housing and there's limited supply. And banks are very happy to make loans to creditworthy Canadians. And when people want more mortgages, banks make those loans. There's no direct link between quantitative easing and the number of mortgage loans. What determines mortgage loans is how many houses people want to buy and what the cost of those houses are. Banks, as I said, are happy to provide those loans. They are subject to capital requirements, leverage requirements, liquidity requirements, and subject to those requirements, they can expand to provide those loans. And a number of witnesses have mentioned this to your committee. There are a number of reasons why Canadians have wanted more houses during this pandemic. And probably the biggest reason is the obvious one that we've all been spending a lot more time at home. Many of us have been working at home. Our children have been studying at home. Recreation is at home. People wanted more space. That increased the demand for houses. Monetary policy has also contributed to that increased demand in housing by lowering our policy rate to the effective lower bound, by using exceptional forward guidance and indicating to Canadians they could expect interest rates to remain low for a considerable period, and by supplementing that with quantitative easing. That all had the effect of lowering interest rates. And so, that definitely includes, it lowered mortgage rates. And when you lower mortgage rates, that encourages people to buy houses. Our economy was in a huge hole. And we needed that stimulus to get the Canadian economy out of that hole. It's worked. And we ended QE last October. In January, we removed our exceptional forward guidance. Yesterday, we raised the policy rate. It's time to get monetary policy back to a more normal setting. The economy has recovered. But just let me emphasize, there's no direct link between QE and mortgages.
Okay, well, I thank you for that. Certainly listening to some around this table at various times in the Parliament, you might have thought that quantitative easing was the reason why we've seen such high increases in the cost of housing. I want to talk to you about, when we talk about interest rates, I want to talk to you about the other side of interest rates that we often don't talk about, because we do spend a lot of time talking about the impact of interest rates on the cost of housing. But we've had very low interest rates in Canada for a very long time now. And the other side of the interest spectrum, of course, is retirement, and how low interest rates affect the retirement savings of Canadians, particularly those. Like, we know many Canadians don't have company pensions. They rely on the CPP and then their individual savings, and the performance of those savings, either through term deposits or investments in the market. So I'm just wondering if you could speak a little bit to the impact of low interest on people's retirement savings, and what you think increases in the interest rate may mean for Canadians' retirement savings.
When we talk directly to Canadians, and we did actually an extended survey of Canadians leading up to the renewal of our inflation control mandate, one of the things we hear from them is, particularly from Canadians who are saving for retirement, is that very low interest rates makes it hard for them to save. And one of the things that was interesting in when we surveyed Canadians is that Canadians, they care about themselves, but they also care about other Canadians, and they weren't very enthusiastic about having negative interest rates like has been implemented in some other countries. They also don't like really high interest rates, and I think, part of that reflects is that if you want to save, having interest rates higher makes that easier. So, look, overall, households' balance sheets have actually performed quite well through this pandemic. In fact, household savings is quite a bit higher. A lot of that has to do with people haven't been able to buy a lot of the things. They haven't been able to travel. They haven't been able to go to the restaurant. So they've been buying more goods, but they haven't substituted one for one. So their savings has gone up. So the balance sheets of Canadians on average are actually in better shape. And with interest rates higher, when they save that, yes, they will get some more return on that. That encourages people, higher interest rates basically encourage less spending and more savings. That's how monetary policy works to moderate spending.
Thank you, and thank you, MP Blakey. That is the time. We are members moving into our second round. In this round, we are starting off with the Conservatives, and I've got MP Fast for 5 minutes.
Well, thank you, Mr. Chair, and thank you, Governor, for meeting with us. It's the first time I've had a chance, I believe, to ask you questions. I want to stay with quantitative easing and monetary policy. The question that Mr. Blakey put to you, which was whether there was a link between quantitative easing and mortgage loans, for me, that's perhaps the wrong question to ask. The question is, what is the connection between quantitative easing and inflation? So my question to you is this: to what extent did the Bank of Canada underwrite the government borrowing that happened during the pandemic period? In other words, the bond buying, and how much liquidity was actually injected into our economy as a result?
I guess there's two parts to that question. If you just want some numbers, our quantitative easing program is on our balance sheet about $300 billion. Those would be our purchases of government bonds in the secondary market. I think I would stress a few things. First of all, the inflation we're experiencing today in Canada is not the result of too much demand in the economy. The economy is just getting back to its capacity. We were in a big hole. We've had a very impressive recovery, and now the economy's recovered. That slack has been absorbed, but it is not causing inflation from domestic sources. And one way to see that is if you look at different parts of the price increases. Goods price inflation, which are largely internationally traded goods, that's a 7.2%. Service price inflation, setting aside housing, is the service component of housing is only 1.6% in Canada.
Yeah,
that's what's more directly linked to demand pressures in Canada. That's not what's causing the inflation.
No. Listen, Governor, I didn't mean to suggest that quantitative easing in Canada was the sole source of inflationary pressures or even the major part. There are a number of other things like supply chain constraints, the spike in commodity prices, which are driving inflation. But when you engage in QE, you are pumping liquidity into the economy. That's more dollars chasing the same number of goods. And I'm not suggesting that was the bank's problem, but you did underwrite about $300 billion of Canadian government bonds, which the government then took and spent in the economy. Am I correct?
Just to be clear, the government has to pay back those bonds. We're not monetizing those bonds. We're buying them. They're on their balance sheet. The government has to pay them back, and when those bonds mature, the government's going to have to pay them.
I understand that. I just want to know, when you underwrite those bonds, the government now has the capacity to spend the value of those bonds in the economy, and in fact, it did. Correct?
The government borrowed money in markets. They have to pay that money back.
Yes.
We bought those bonds as a way because our policy rate was at its effective lower bound, we couldn't lower our policy rate anymore. So a different way to lower interest rates is to buy government bonds. That pushes their price up, drops their interest rate. It's a different way to lower interest rates. It's not monetizing the debt.
How much time do I have?
That did provide stimulus.
Yes, I understood. It provided stimulus, and the stimulus was required. I'm not challenging on that. I'm just suggesting to you that when you engage in bond buying, the government has the capacity to spend that money. In fact, it does, which in fact injects stimulus into the economy. Let me go to another question. You mentioned high household debt, and that concerns me as well. Our household debt to disposable income ratio today is what, around 180%, which is significantly higher than that of the US. So my question to you is, has the Bank of Canada done calculations on the impact which higher interest rates will have on highly indebted consumers, those who have, who are indebted on big mortgages, on big credit cards, other consumer loans? Have you done that work?
I'm going to actually take the opportunity to bring Senior Deputy Governor Rogers into the conversation. Carolyn, why don't you take that question?
Yes, thanks, Mr. Fest. It's an important question, and most certainly this is something the bank spends time thinking about, and it's part of how we look at the effect of our monetary policy decisions on the Canadian economy. What I would say, a back of a napkin calculation on today's interest rate announcement, for example, would be about $12 on $100,000 of mortgage debt. Now, there's lots of assumptions in that calculation, the term and the rate on the mortgage. What's important to know about mortgages, though, is most mortgages, even variable rate mortgages in Canada, have fixed rate payments. So there isn't an immediate change to payments. Now, there is a change to the portion of the payment that's going to principal. It'll take longer to pay down the mortgage. So acknowledge that.
Thank you.
But certainly
Thank you, Ms.
more
Rogers.
indebted economy.
Yeah. We're well over 6 minutes, but thank you very much. Thank you for that. Okay, we are moving to the Liberals. Ms. Zarowitz for 5 minutes, please.
Thank you so much, Mr. Chair, and I want to thank the Governor and the Deputy Governor for being here today. Thank you so much for your important service to our nation. I want to just start off very quickly just to correct my Conservative colleague who started out the gate by indicating that the government continues to believe that we need that the economy needs more stimulus and investment. And so I just want to just put on the record that what we have done as a government since last summer, we have been very deliberate about reducing the funding around our emergency programs. And it's been very targeted because what we wanted to try to do is, as we're coming out of COVID, we wanted to reduce the amount of money we're giving, but not too quickly so that it destabilizes the foundation of our economy from which we wanted our businesses to continue to pivot and to rebound. And so I want to also then maybe go to you, Governor, to just say thank you. I appreciated you indicating to us that our fiscal policy was successful, that our generous emergency programs have worked both to stabilize the economy and to help it largely recover to where it is today. So my first question is actually to households, because as you rightly pointed out, everybody's worried about the rising costs of, it seems, everything. And I wonder whether you have done an analysis on how it's actually going to be impacting households in terms of interest rates increases.
There are households are in a wide diversity of situations. As Mr. Blakey's question suggested, if you're getting close to retirement or retired, you're looking at the interest return you can get on your savings. If you're looking to buy, if you're younger, you're looking to buy your first house, of course you're going to be borrowing and you're going to be paying that interest. So Canadians are in a wide, there's a wide spectrum. What I can say the balance sheets of Canadians on average are improved actually over the last year. There's about $200 billion of what economists call excess savings in the households have built up, as I said, because they have been unable to buy a lot of the things they wanted to buy through the pandemic. Now we're already seeing that they particularly through the fall as things reopened, they came back to restaurants, they came back to recreation, so they are that savings rate is starting to come down, but there's still a stock of extra savings. But that's not every Canadian. Some Canadians have really stretched to buy that first house, and they are going to be more affected when interest rates go up. And as I said earlier today, we recognize that higher interest rates are going to impact Canadians, and we're going to be deliberate. We're going to be careful. We're going to be mindful as we do that, and we're going to assess the impacts along the way. The economy is strong, and we certainly think it can handle higher interest rates. We think it needs higher interest rates. But being on a rising path doesn't mean we're on autopilot.
Thank you. As you rightly noted, we're very much engaged in Ukraine and the Russian aggression into Ukraine. Can we do both, sort of spend on supporting Ukraine and tackle inflation at the same time?
Well, again, the spending decisions are really the decisions for governments. Spending on the Ukraine, I guess it depends what you're spending the money on, but if you're sending them aid, that's not really going to create inflation in Canada. It would create a bigger deficit, but it's not spending in Canada, it's spending in the Ukraine.
Thank you. My next question is, I know that the bank is very much going to be working on sort of reducing inflation. Are there any external factors that will also help support reducing inflation? So perhaps maybe, businesses who will also help to tackle the supply chain issue, or maybe some other things that might be also helping to putting a downward pressure on inflation beyond the work that the Bank of Canada is going to be doing.
I'm going to ask Senior Deputy Rogers to lead off on this one.
One of the most important things that will help on inflation is an improvement in productivity. So lots of businesses have been affected by the pandemic. Their productivity has been affected by the pandemic. You see it when you walk into a grocery store or a restaurant. We've got extra staff checking vaccine passports or providing support in cleaning or queuing or that sort of thing. So as the pandemic lifts and as the economy continues to recover, we expect productivity will pick up again. And when productivity picks up, the economy can take more demand without the price pressure. So certainly the productivity will give a lift. It will help us in the fight against inflation.
And I'll just add, there are key investments.
Yeah, Governor, that was the time, but I'm sure you're going to have an opportunity in another round. We are moving to the bloc, and Monsieur Sainte-Marie for 2.5 minutes.
Merci, Monsieur le Président.
Thank you, Mr. Chair. Governor and Senior Deputy Governor, I would like to know what led you to choose not to raise the policy interest rate last January, and more specifically, how the following points might have influenced your choice. First, the economy had not yet recovered sufficiently based on your criteria. Secondly, following the commitment not to raise the policy interest rate until a certain point in time, until the economy came back to full operating potential. And third, your monetary policy being linked to that of the AFID. Well, Canada's monetary policy, the reason why we have the Canadian dollar is because we do have an independent monetary policy. It is ours, not that of any other countries. We do take into account what goes on in the United States, but we make our decisions here in Canada for Canadians. Secondly, what we did in January, why we made the decision we did. In January, we decided that the excess capacity had been absorbed, and thus we did not need from any special indications. We didn't need to say that we needed to keep the interest rate at its lowest rate. We backed off on that commitment, and we gave a clear signal to Canadians that they could foresee rising interest rates. And our point of view was that this would be an important change in our monetary policy. It was important to think it through carefully, to be transparent about it, to provide Canadians with information about it. And yesterday, we took our first step in this new direction of raising interest rates. Thank you. So we can now expect gradual increasing of the policy interest rates over the next quarter? Yes, you can foresee having interest rates rise higher. The interest rate rising should stabilize monetary policy, given that the economy will be coming back to full operation.
The NDP, MP Blakey, for 2.5 minutes.
I think one of the challenges right now for a lot of folks is trying to square things that we hear, like the numbers you cited earlier about household savings being up, with the very clear pressure that so many Canadians are facing in terms of pricing. There are concerns about, I think there was a poll out earlier this week that says over half of Canadian households are worried that they can't keep up. We know that before the pandemic, somewhere in the neighborhood of about half of Canadian households were about $200 a month away from insolvency. So it's trying to square some of the different, messages that we're hearing. And it seems to me that in part, the answer lies in this other component that's a lot less talked about, unfortunately. The Parliamentary Budget Officer put out a report in December or thereabouts saying that 1% of Canadians right now are sharing 40% of the wealth that's generated in Canada, or 40% of Canadians rather are sharing 1% of the wealth. 1% of Canadians are sharing 25% of the wealth, or own and control 25% of the wealth. Now, so when we talk about, average household savings being up, that can be a positive thing overall at a macroeconomic level. But those averages can really hide some disparities depending on where people fall in terms of their revenue category and their socioeconomic status. So I'm wondering if you might explain to us how the bank analyzes that component of the problem. And when we talk about optimism because of average household savings, to what extent that's skewed by some households having proportionately much larger savings and so many households still living paycheck to paycheck.
It's a big question. So let me offer a couple of things. First of all, monetary policy is, by its very nature, it's a very macro tool. And we have one rate of inflation for the whole country, the CPI inflation. That is our target. We have one interest rate for the whole country. That's our instrument. And we obviously can't target specific groups. Low inflation, one of the big costs of inflation is that it does hurt low-income, poorer people the most. And when grocery prices go up, when gas goes up, it bites for them the most, and that's one important reason why you want to keep inflation low and stable. One thing we have been doing, though, is that And this pandemic's been a very good example. You can't understand the macro economy without looking at a more granular level at the experience of different Canadians in different sectors, of men, of women, of youth, of racialized Canadians. You need to look at the different experiences to get an understanding of that macro picture. You know, probably the most important thing you can do to create more equality in this country is to get everybody back to work. And, you know, if you look, I mean, the effects of this pandemic, it wasn't just that there was 3 million people at work. I mean, that is an unbelievably huge number. But it was also just how incredibly uneven it was. It was very concentrated in youth, low-income workers, women. And as the economy has recovered, the good news is that those inequalities have dramatically diminished. In fact, youth employment, female employment is now above pre-pandemic levels. Low-wage workers have come a long way back.
Thank you, Governor.
There's still some room there.
Thank you. Okay. Thank you, MP Blakey. We are moving to the Conservatives and MP Fast. I've got on my list. Oh, okay, MP Albus.
Great. Thank you, Mr. Chair. Thank you, Governor. Thank you, Senior Deputy Governor, for your presence here today. Governor, before we go any further, you had mentioned to MP Blakey that there was no relationship between QE and mortgage prices. I was always under the impression that bond prices and mortgage interest rates have an inverse relationship. Maybe I heard wrong. Could you maybe clarify your remark?
I'm happy to. So, when you engage in QE, yes, you're buying government bonds. That pushes their prices up. That lowers the yield on those bonds. And yes, as you suggested, if you lower the government bonds are the benchmark that everything else is priced on. And as I responded in my answer, QE contributed, along with the other monetary measures we took, to lower mortgage rates, and that did support the housing market. When I said there was no direct, what I meant was there's no quantitative. You know, banks don't need our settlement balances to make mortgage loans. And when we move to quantitative tightening, I can assure you that banks will still be making mortgage loans.
Okay, thank you, Governor.
The prices will change, but it's not a quantity link.
And that's you said earlier we may have the opportunity to explore housing further, and I certainly want to do that here. But in regards to that 43% increase in the average home price in 2 years. Now, I want to ask you just specifically on that. How do you get that kind of increase, especially given the amount of quantitative easing that the Bank of Canada has undertaken over the past 2 years? If you could maybe explain how that is, because it sounds to me that for whatever reason, and look, I'm not looking backward, I'm looking forward, but I'm trying to get an understanding of how you can have 43% increase in just a 2-year period.
Housing prices have gone up a lot. The housing market is very elevated, and we cannot continue to see the kind of increases in housing prices or the kind of growth rate we've seen in housing. I just want to be very clear on that right off the top. Why have housing prices gone up so much? Look, it's a combination of there's been a lot of demand for housing and there's been limited supply. I know a number of witnesses before the committee have talked quite a bit about supply, CMHC, as well as others. And the fundamental solution to reducing house price increases is to increase the supply of housing in this country. That's what's actually going to get people into the houses they want. I am pleased to see that across different levels of government, there is more focus on supply. This issue of high housing prices, elevated household indebtedness, as people stretch to buy those houses, this has been going on for the last 7 or 8 years. This predates the pandemic. The pandemic has, like it has to so many things, it has intensified.
Governor, just with all due respect, is that I'm asking you about the last 2 years. has quantitative easing affected interest rates and added fuel to the fire when it comes to our housing costs?
Quantitative easing, together with the other measures we took, did lower mortgage rates, and that contributed to the strength of the housing market.
Okay. Okay. Well, again, some people say that 43% is pushing home ownership, the goal and dream of many Canadians, away even further. So your predecessor had mentioned once at committee that he'd like to see more different offerings of different types of mortgages. He says that we didn't have a variety of different mortgages that could meet different needs. Would you happen to agree with that? Should there be more innovation in the mortgage space than what we have today?
Innovation that creates more opportunities for consumers. Yes, I think that would be a good thing. I do think one has to be careful about innovation. We have to make sure that these are innovations that are robust and that will, we saw a lot of innovation in the mortgage market in the United States in sort of 2004, 5, 6, and it ended very badly. Fortunately, in Canada, we were not as innovative. We did have some of that going on in Canada, but it was much smaller.
What would be some positive innovations from your perspective?
Well, I don't really have any specific suggestions. I mean, these are decisions for businesses to engage in. I don't know if Senior Deputy Governor Rogers may have some perspective on that.
I think the member was talking about some suggestions for longer-term mortgages. I remember when Governor Polos spoke to you about that. I think, as the governor said, innovation that comes along, not at the expense of stability, is good innovation. So certainly terms would be one thing to look at.
Thank you, and we thank you on that, and thank you, MP Albus. We are moving to the Liberals, MP MacDonald, for 5 minutes.
Thank you, and thank you, Governor and Deputy Governor, for being here today. Very interesting conversations that we're having, and clarification on a lot of issues and a lot of questions that many people are asking. I just want to go back to your quantitative tightening relative to the bonds. And so can you just describe when and how you analyze removing those bonds from your balance sheet?
So there's various phases. So we were engaging in quantitative easing. We began October of 2020, what we call tapering, or reducing the amount of quantitative easing we were provided. So buying less bonds. We started at $5 billion per week. We went to 4, to 3, to 2, and then we ended quantitative easing, which means we entered something we call the reinvestment phase. So we only buy enough government bonds to replace the bonds that are maturing on our balance sheet. And right now we are in the reinvestment phase. And what we indicated yesterday is that we will be considering moving to the next phase. We had indicated that we would stay in reinvestment until we raise the policy rate. Yesterday we raised the policy rate. The logical next step is to consider not replacing the bonds that are maturing on our balance sheet. That's called quantitative tightening. And we indicated that we would be considering quantitative tightening, when to start it. And as I said earlier today, at our next, I think you can take from that at our next monetary policy decision in April, we will certainly have a live discussion about ending reinvestment and beginning quantitative tightening. When we get to quantitative tightening, what that means is that we won't be replacing the Government of Canada bonds that are maturing on our balance sheet. So our holdings of Government of Canada bonds would diminish. And to give you a picture of the speed of that, about 40% of the government bonds on our balance sheet would roll off over 2 years.
Thank you.
Or they've got 2, yeah. I'll stop there.
Yeah. Another question was, can you explain, we hear it all the time that we're moving too quickly or we're not moving quickly enough. relevant to monetary and fiscal policy. What happens if those contract too quickly at the same time?
Well, what happens if there's too much tightening too quickly? The economy is going to slow, and inflation will actually fall below its 2% target. There'll be more people out of work. There'll be less income in the economy. If there's less income in the economy, there's less spending, and that people aren't buying goods, and the prices, the inflationary, the people, companies start discounting those goods. Inflation comes down, and it's too low. It's below our target. So if you look at our projection, we have quite solid growth this year and next, with inflation coming back to target. Now, yes, it's a delicate job trying to balance those things, and we're going to assess that at each decision going forward.
Thank you. And I want to come back to non-traded commodities, which I think a couple members have already spoke about a little bit, and the effect of the Ukraine or Russia invasion on Ukraine. How people on the street are wondering, those non-traded commodities, how and what effect is that war going to have for them? And I know you touched on some of it, but I'm just seeing how deep you can go on that and give us a more precise answer.
Well, the direct, the effects on Canada through commodity prices. So, just to be clear, what we're talking about here, we're talking about the price of oil, we're talking about the price of natural gas. We're talking about the price of wheat, the price of potash, the price of nickel, commodities that
Governor,
Russia and
the non-traded commodities. So it's more, to me, I thought I'd be dealing with more of health, education, that kind of stuff.
My apologies.
Oh, that's okay.
I misunderstood.
Yeah.
So when you say non-traded commodities, you mean services?
Yes.
Okay, services. Well, I look. There was, in terms of the impacts on Canadian services, I don't expect there will be much impact. There global uncertainties increase. There's more volatility in financial markets, and this may, and we could see some supply disruptions, and this could weigh on growth, but. I don't see very big impacts on things like health and education in Canada.
Thank you very much.
Thank you, and thank you, MP MacDonald. We are moving to our third round members, and we have the Conservatives up first, and MP Lawrence for 5 minutes.
Thank you very much, and thank you for appearing today, Governor. I just wanted to go through and focus on a particular area with inflation, and that's with respect to energy. In 7 of your 11 last press releases, you stated either energy, gasoline, or oil were the cause of significant or driver of inflation. If we were able to produce more energy, more oil in Canada, and we were able to be more energy independent than we are currently, such as not importing oil from Russia or other countries around the world, would Canada be in a better position to control its inflation?
We're big exporters of oil in global markets. Oil's.
So, Governor, if we were able to increase the amount of oil and gas that we were able to put into the global market, as you've stated, 7 out of 11 press releases that this is a major driver, that would have a reduction of inflationary pressures.
On the margin, if Canada produced and exported more oil, it could reduce the.
I can tell you in my town of Orono, where you talk about excess savings, they're talking about they can't pay their heating bill. They're talking about the fact that they can't afford their gas and their oil bill. And so if we saw, for example, a decrease in 10% in the gasoline costs or oil costs or fuel costs of Canadians, would that impact inflation?
Yes. It would bring it down.
So so the carbon tax equates to about a 10% additional cost on oil and gas. So if we were able to give Canadians a holiday for a period of time, would this help them cope with the additional pressures that they're facing as a result of inflation?
We actually, in our monetary policy report, we report on the impact of the carbon tax on inflation. It's about 0.1% per year. The reason for that is that the carbon tax is increasing over a very long period of time. So
yeah, it's about ready to go up. But if you look at the cost of petroleum today to fill up your gas or to heat your home, or in farmers' cases, the ability to heat their livestock, it can equate to far more than 0.1. I can assure you. According to the Saskatchewan agriculture producers, it was costing their farmers on average of a 10% additional cost. If you look at the cost of gasoline at the pump, it's 10%, sir. So, excuse me if I question your numbers.
Yeah. Well, the 0.1 is the addition the impact of increasing the carbon tax over time.
And I wasn't talking about that.
Obviously, if you eliminate it, yes, that would have.
So, yeah, what I was talking about was giving.
That would have a bigger effect.
Yeah, what I was talking about is giving Canadians a holiday, not on the increase, but on a holiday from the carbon tax.
I don't have that. I don't have that number in front of me. Sorry.
Well, if you said that there a 10% reduction in the cost of fuel would have an impact on inflation, and carbon tax equates to about a 10% cost, it only makes sense. Therefore, if A equals B, B equals A equals C, like, it makes sense. And so the carbon tax. So could we have those numbers? Could we have the impact of the carbon tax in total, not the increase, on inflation?
Yeah, we could get those numbers.
Thank you for that, Governor. The other thing that I found a little bit odd is that on one hand you talked about the fact that monetary policy couldn't lead to inflation or wasn't leading to inflation. However, at the same point you gave yourself a pat on the back earlier on and said, well, it was monetary policy that saved us from deflation. Maybe I'm just not understanding. If you could clarify that for me, Governor.
Yes. So if you look at where the economy, so if the economy is operating below its capacity, that tends to put downward pressure on inflation. If it's operating above its capacity, that pushes inflation up. The economy's been below its capacity for the last 2 years. It was initially way below its capacity, and it has recovered actually impressively, and is now back to its capacity. But it's not in excess demand. It's not above its capacity, or at least not significantly above its capacity. So the inflation we're seeing is not being generated by too much demand here in Canada. It's being generated by these international factors, which I mentioned.
All right, I will yield the time there, because.
Thank you, MP Lawrence. We are moving to the Liberals. MP Baker for 5 minutes.
Thanks very much, Chair, and Governor. Thank you very much for making the time to be with us today. I have to tell you, I have a finance background. I've studied economics and 2 business degrees, and just listening to your testimony over the last little while, I've learned a tremendous amount already. So I thank you for your time and for being here. I also wanted to say that I was reading your bio, and I know that you've been, if I'm not mistaken, you studied at Queen's. And you studied at the University of Western Ontario, and you were also, of course, dean at Rotman, the Rotman School. And I'm a Schulich grad, and I'm going to try not to hold that against you as I ask the remainder of my questions, if you don't mind. So the first question is going back to our current rate of inflation relative to our international counterparts, and I'm wondering whether, Governor, if the rate of inflation that we're seeing in Canada, is this unique to Canada, or is this a global challenge?
Well, I'm just going to begin by saying there are a lot of great universities in this country for which we can be very thankful. But I'm going to ask Senior Deputy Governor Rogers, actually, if she wants to say a few words about international inflation. She's recently moved back from Europe, so she can give us a more global perspective.
Well, I mean, I think the short answer is would be covering some of the ground we've already covered today, Mr. Baker, is that, as the Governor said, the inflation that we're seeing today is not a result of excess demand. It's a result of a number of unique factors, stemming in large apart from the pandemic. So it's a result of global supply chains, problems in global supply chains, and then increased prices for commodities are traded globally, like oil. So this is why you see a very consistent picture of inflation around the world, regardless of the differences in economies. And I know in previous questions and previous discussions, there's been discussion about why different economies are seeing different rates of inflation. But again, those, as we pointed out earlier, the G7 countries, we all have quite different economies, but you see pretty consistent levels of inflation, and that's because they're coming from the same source.
Yeah, no, thank you for that. So it sounds like it's a global phenomenon. Can you share, how does our rate of inflation compare to other countries around the world? Are you able to indicate that to us?
Yeah, I mean, I think earlier we talked about G7 countries, so France, Italy, UK, fairly consistent. I think the latest numbers out of Europe are just above 5, slightly above where we are. The US inflation rate is a bit higher. There is small differences in the way inflation is measured in some of these countries that we can attribute some of the differences to. So for example, in the US, used cars play a larger role in inflation measurements than they do here in Canada. But you've also seen the effect of the economy rebounding a bit more quickly in the US because of differences in health measures. So there's a variety of different factors that contribute to inflation. But again, you come back to what are the largest contributing factors in all of these countries. You would hear supply chain pressures and commodity prices.
Okay, thank you very much for that. Can we, Governor or Senior Deputy Governor, how does the current economic recovery in Canada compare to the recovery from past recessions in Canada?
Well, I would say, look, everything about this recession has been very different from past recessions. First of all, it's incredible severity, its suddenness. It's the fact that basically almost every country in the world went into recession on almost the same day. The recovery has also been the strongest on record by far. And to some extent that reflects the fact that part of the cause of this recession was, truly exceptional public health measures needed to be taken that literally closed parts of the economy. And so when those were reopened, the economy bounced back very quickly. The other element is the exceptional stimulus that has been provided here in Canada and in many other countries around the world. Faced with an economic catastrophe, many governments have deployed exceptional policies, and they've worked.
Great. Thanks very much, Governor.
Thank you, and thank you, MP Baker. We are moving now to the bloc. Monsieur Sainte-Marie for 2.5 minutes.
Oui, Monsieur le Gouverneur.
Yes, thank you. Governor, on the 7th of February, the American economist Joseph Stiglitz wrote an article entitled A Balanced Response to Inflation. I'll read you 2 sections of it, and I'd like your opinion. At the beginning of the text, he writes the following: My main concern, however, is about the risk of having the central banks overreact, speaking of inflation, of course, by too rapidly raising interest rates, which would interrupt with recovery. As always, those who are at the lowest income levels would be more likely to suffer in that case. And the other quote is from the end of the article, where he writes as follows: What we do know is that an overall raising of the interest rate, the policy interest rate, would be a medicine worse than the illness. We should not attack the offer, the supply. It would bring up the unemployment rate, and this would also ruin people. Your comments. All right, there are many elements in that evaluation. I do agree with some elements, but not the overall point being made in the overall analysis. I do agree that monetary policy cannot directly address the fact that commodities such as oil are highly priced. It cannot solve global supply chain bottlenecks either. However, as I have outlined, it is very important to have a monetary policy that keeps inflation forecasts well balanced and grounded, because when the price of commodities such as oil go up or down, and when the supply chain bottlenecks start to ease up, pressure on inflation will drop. Inflation will come down. If our inflation forecasts are well founded. So it's very important for monetary policy to keep that approach. Thank you.
Moving to the NDP and MP Blakey for 2.5 minutes.
Thank you. One of the questions I wanted to touch about, that there was a lot of discussion around the time that the mandate was being renewed, was the question of full employment being one of the objectives within the mandate of the Bank of Canada. And of course, a decision was taken not to include that in the mandate of the bank. And I just wonder if you could take some time to speak to that decision and the big question mark that's out there for, over 6% of Canadians who, despite a lot of talk in the economy of employers who need employees, there's nevertheless a stubbornly high unemployment rate. So, why was there a decision not to include that in the Bank of Canada's mandate, even though it's clearly something that it seems the bank will be paying close attention to? And what do you think the path out of that stubbornly high unemployment rate is, and how can monetary policy help in trying to bring that number down? I thought of this in your reply to my last question. You had said that the best way to fight inequality in Canada is to get everyone back to work, but of course there was just a decision to say that's not part of the mandate of the Bank of Canada. So I'm hoping if you could help us to understand that decision a little bit better.
It's a lot for 6 minutes, but let me try to go at it quickly. I'm very pleased with the renewed mandate of the Bank of Canada. I think the mandate, the renewal, in some sense, really it reflects the success we've had over the last 30 years. It also clarifies the role of employment in our framework. And what I would stress is that the economy's got to be at full employment to keep inflation at target. If we're below full employment, the economy's missing jobs, it's missing wages, and that means it's missing spending, and that means inflation's going to be below the target. And where I think one of the things I like about the new agreement is that it is clearer about that. It is clearer that we have a role to play consistent with achieving price stability in supporting employment. It's clear that our primary objective is price stability. It also, as part of the agreement, we indicate we will be providing more analysis of labor markets. We've already started that. If you look at our last monetary policy report, actually, you will see an extensive discussion of a very wide range of labor market indicators. And we are using those, not just the sort of aggregate ones, but looking at the inclusiveness of the labor market, looking at the characteristics of jobs, like the hours worked, like the wages.
Thank you, Governor.
As a way to come to that overall assessment of how much slack is in the economy.
Thank you, Governor. And you encapsulated all that into 1.5 minutes. So that was great. Thank you. We are moving to, and thank you, MP Blakey. We're moving to the Conservatives. We have MP Chambers up for 5 minutes.
Thank you very much, Mr. Chair. Thank you, Governor. I'd just like to take you back. You've mentioned a couple times the very unconventional time we found ourselves in 2020, and some of the tools that we had never used before. We kind of brought them to bear on the market to make sure that interest rates and the market was continuing to function. And that, of course, is the QE that you've spoken about. At some point, the QE became more of a regular policy tool that we used kind of on an ongoing basis versus that really immediate short-term need that we had when everything started. And you also mentioned when we last spoke about the bank making its policy choices, based on some of the decisions made by the federal government Department of Finance. And so the question is, we know that QE has helped keep interest rates low. So the flip side is QE would have, had we not done it, had we not purchased government bonds, interest rates would have gone up. And so, I'm curious as to whether the bank really had a choice, whether it would do QE or not later in the pandemic when it was presented with fiscal plans from the government that we knew were going to spend $100, $200, $350 billion.
Well, the bank certainly has a choice, and we use our tools to achieve our inflation target. And the reason we threw a lot at this problem at the beginning was we were in the biggest, sharpest recession we've been for many, many generations, and so we threw a lot at it. The other thing I would stress is that our primary instrument is interest rates. The reason we resorted to forward guidance and QE was that we'd lowered the rate as low as we could go. We've now increased the rate. We've ended QE last October. We've now increased our policy rate. We are considering quantitative tightening. Our policy rate will remain the principal instrument.
That's fair. Thank you. I just when you're presented with a fiscal plan of a government and we want to keep interest rates low, in my view, it didn't leave the bank much opportunity to change away from its course. But let's move on to talking about low-income Canadians. You gave a speech a year ago. You've mentioned it here again today. Inflation has such a significant effect on low-income Canadians, those individuals who are cash-strapped, if you will, or living kind of month-to-month, paycheck to paycheck. Our decision, the government's decision, the bank's decision to kind of continue the lower for longer and longer still interest rate policy has had a significant effect on these individuals. How would you, recharacterize what you said just a year ago?
I remain concerned that inflation has a disproportionate effect on lower income Canadians. That is one of the reasons why it's so important to get to maintain low stable inflation. The people that suffer the most are the least able to afford it. The inflation, though, as we've gone over a number of times, the inflation that we're seeing today is largely driven by increases in globally traded prices. And it is critically important that we move interest rates up to keep inflation expectations well anchored and moderate spending to get inflation back. It will take some time to get there. Our tools do take some time, but I am confident we'll get there.
Thank you. Appreciate that. And hopefully we will continue on this path where we get inflation under control. Final question. We talk a lot about inflation expectations and anchoring. I know that's something you think a lot about. In October, there was two risks that you had put forward to the outlook of the economy, and that was inflation expectations and wage expectations. And the bank's own research in January indicated that businesses, for the first time in a really long time, believe that wages will be higher 12 months out from now. And for the first time in a long time, or the highest that's ever recorded, that they expect prices to be well outside and above the inflation target range. Are you concerned that this inflation expectation is now actually taking hold in the economy?
Well, I'm glad you're looking at our surveys very carefully. Yes, as I highlighted today, as we highlighted in our press release yesterday, we are concerned that the longer that inflation stays well above our target, the bigger the risk is that inflation expectations start to drift up. The other thing we're concerned about, which I talked about at some length today, is that inflation is high. It's also broadening. It's, if you look at the various components, there's 165 components of the CPI. Roughly two-thirds of them, almost two-thirds of them, are now rising above 3%. So that what that means is that, even if you're a very careful, diligent shopper, and you really look for the best deals, it's hard to avoid the inflation that we're experiencing today. And that does raise the risk that people start to think that these high price increases are going to continue. And if that happens, the risk is that inflation expectations become unmoored, and it gets a lot harder to get inflation.
Thank you,
back
Governor.
to target.
Thank you, and thank you, MP Chambers.
Thank you.
That's the time. We are moving to the Liberals. MP Chattel for 5 minutes, please.
Thank you, Chair. I would like to start with bringing some inconsistency that I see with the conservative economic policy. On the one hand, it seems like they think that the government spending that we did to protect our economy has created inflation. And at the same time, they're particularly concerned about inflation in housing. But as you said very well, Governor, today, it's not about spending, it's what you spend on. And if you spend to increase the supply of housing, for example, you actually reduce the pressure on the inflation pressure on housing. So I hope that they will reflect on that and focus on what you spend on is really the key to increase the supply in some pressure point. Mais, Monsieur le Gouverneur,
But, Governor, if I may, what is of concern to me now is climate change. Because we do know, and you yourself have said, that climate change will bring about droughts, which will put upward pressure on the price of food, agricultural commodities, and also supply chain disruptions. Yes, indeed, at this point, governments are using the tools that they have to green the economy, and one of the best tools at the OCDE, and there seems no question about this among economists, is putting a price on pollution, which would help the economy move away from carbon to a greener future. So what is your view of the effect of climate change on inflation, especially for food, which is so important for people, low-income Canadians? We are starting to work on the impacts of climate change and on monetary policy. If it's how it should be taken into account. It's not something that feeds into our monetary policy at present, but it is something that we have begun studying. We carried out a study with the Office of the Superintendent of Financial Institutions of Canada and 6 major financial institutions of Canada, using something that we call scenario analysis. It's very difficult to foretell what will happen with climate change, given that there's a good deal of uncertainty in the modeling, but we do use scenarios. We can use them in order to see what the effect of various scenarios would be. This is to help our financial institutions manage the risks on their balance sheets relating to climate change. But If we're in a better position to understand the risks, the financial system will be in a better position to allocate its capital to more sustainable investments. But it is not our role to direct policy about climate change. That is sort of your job, isn't it, here in the Parliament of Canada? But we do have a role to play in helping financial markets manage the challenge and the risk. And we do have work to be done to better understand the effects of climate change on monetary policy. But to be quite clear, climate change will necessarily, and it's clearly seen now, put upward pressure, inflationary pressure on agricultural commodities. Yes, indeed. It is quite clear that over the past year, the droughts, the major storms had an effect on agricultural products, and part of that is attributable to climate change. But we have had droughts before that, of course. So we need to be very clear as we separate this out and understand the science of it all. That said, the effect in Canada out west on agriculture, yes, there was a drought out west, and that had an effect.
Concludes our third round. We are going into our final round, members, and as we do on this committee, if there is not enough time for a full round, we divvy up the time between all the parties. I'm looking at about 4.5 minutes for each party. We will start with the Conservatives for 4.5 minutes, and MP Fast, you have the floor.
Well, thank you. Governor, much of your analysis has focused on the supply side challenges that are driving inflation, such as supply chain constraints. And you suggested that is the major driver, and I'm inclined to agree with you on that. However, there are some that are expressing concerns about the demand side. For example, the chief economist from the TD Bank has recently said that demand driven by the rebounding economy and stronger household buying power will offset much of the relief on the supply side. And I'm wondering, do you agree with her, or is there a risk on the demand side that we're going to see effectively a two-pronged pressure on inflation in Canada?
Well, actually, I haven't actually read that publication from TD, but yes, what I've been saying is that the economy has recovered. Slack has been absorbed. There is solid momentum in demand. We had a very strong second half of last year. We're coming out of Omicron, and we're expecting to see continued strength, and that does mean there is a risk that demand starts to run significantly ahead of supply. And if that happens, we will have a new domestic source of inflation. And that really comes back to why we've started to raise interest rates and signaled that we expect that we will need to continue to raise interest rates so that we can moderate that spending growth and keep demand and supply roughly in balance.
Governor, is there any justification for further stimulus being injected into the economy, either through QE or through government spending?
Well, we don't need QE anymore. We shut it. We ended QE last October. In fact, we're now considering.
What about on the government spending side?
Look, I'm going to leave decisions on government spending to our members of parliament.
All right. Let me ask you about Mr. Rosenberg, David Rosenberg, someone that you would be familiar with. he has suggested that by the end of 2022, this year, we will be looking at a recession rather than talking a lot about inflation. Do you agree with him? And if not, why not? And are there steps that you are taking to ensure that we don't slip into a recession?
Our forecast doesn't have anything that looks like a recession. Our forecast has really quite solid growth for this year and next year. It is moderating, but it is solid. Look, we think interest rates need to go up to moderate growth. We think the economy can handle that. We think the economy needs that to bring inflation back to target. But we do think we can grow this economy and bring inflation back to target.
I want to go back to the testimony that you gave on liquidity and quantitative easing and its relationship to inflation. Is it your testimony that, in fact, liquidity in the marketplace does not drive inflation?
So just to be clear, what I was saying was there's no direct quantitative effect between the size of settlement balances and the number of mortgages that are written in this economy. Banks don't need settlement balances or QE to write mortgages. And when we go to QT and we're reducing the size of our balance sheet, banks will continue to write mortgages. That said, lowering interest rates, using forward guidance, supplementing that, reinforcing that with QE, all worked to lower interest rates, lower mortgage rates, and that definitely did contribute. That definitely has contributed to the strength we've seen in the housing market. Our economy needed that stimulus. The economy's now recovered, and we're now on a path to normalizing monetary policy.
Thank you, Governor. Thank you, MP Fast. We are moving to the Liberals, MP Zerowitz, for 4.5 minutes.
Thank you so much, Mr. Chair, and I want to thank the Governor and the Deputy Governor for being so great and continuing to be with us and being part of this really excellent conversation. Governor, my colleague had talked a little bit about your academic background. One of the things that I always remembered very clearly is that you were part of writing a seminal report around sustainable finance that I've always read and I've thought it was excellent. I believe you do know that we as a federal government have a very aggressive agenda to decarbonize and to move to net zero by 2050. It will require, we've committed about $100 billion in spending and over 100 different things that we're planning on doing. Given the concerns around inflation, do you think we should be slowing down?
Again, I'm really going to leave these decisions for our elected members of parliament to take. These are spending decisions, taxation decisions. Those are decisions.
I suspected you might say that, Governor, but I do want to thank you for your excellent work around sustainable finance. I will go back to productivity then. You had, last time I was asking about, we had sort of ended the conversation around productivity, and I think you were about to say something. I don't know if you recall that, and if not, I will go on to a continuing question I have around productivity. Do you?
I think what I was going to say is that, look, a key part of productivity is for businesses to invest in workers, invest in new capital, because when you give workers better tools, they're more productive. And higher productivity pays for higher wages. If wages go up because productivity went up, that is not inflationary. And one of the things I was pleased to see in the fourth quarter data was that actually we are starting to see that rebound in investment. And when we talk to firms, their investment intentions have never been stronger. And we very much hope that companies follow through on those business plans and make those investments.
And so that leads to one of the things we've heard on this committee through the years is that one of the best ways for us to improve productivity at a very low cost is by us actually continue to work on eliminating the different regulations between the provinces and the trade barriers between the provinces. Would you agree that that needs to be a continued focus, and two, that that would actually greatly increase our productivity?
Look, I think that would be a very good idea. There are a number of things governments at all levels could do that wouldn't cost them any money, that would get this economy working better. It would make it. It's partly productivity. It's partly it would help workers. Workers could move between provinces, and get jobs that were better suited to them. And so yes, I mean there are a number of regulations that have probably outgrown their usefulness, and it would be a good idea to look at those.
Well, thank you, Governor. I'll say to you that you're good luck, just because I from the opposite bench, I'm hearing my colleagues say that they very much support that as well. So I'm hoping that we might undertake that as an urgent study. I think particularly as the world becomes more unpredictable and unstable, strengthening our internal economy and our Canadian economy, I think would be beneficial for all Canadians and Canadian businesses. Do I have time for one more quick question?
Yep. Really quick.
Governor, this morning you noted that you expect inflation to come down the second half of this year as we see challenges of the pandemic ease. Can you elaborate on this, please?
Yes. So, as I've discussed, much of the inflation we're seeing is related to this combination of a big shift away from services into goods because people couldn't buy a lot of the services during the pandemic, combined with supply bottlenecks, impaired global supply chains. As the pandemic eases, we expect that people will start to go back to buying all these services they want. They're going to start to travel. They're going to go to the restaurant. They're going to go to a rock concert. And as they're going to spend more on services and less on goods, that'll take some pressure off these global supply chains. At the same time, we're seeing a lot of investments to try to improve these logistics and strengthen these supply chains. So those things should ease and inflation should come down, but it will take some time.
Thank you, Governor. Yeah, now we thank you, MP Zerowitz. We are moving to the block, and MP Samari for 4.5 minutes.
Merci, Monsieur Fonseca.
Thank you, Mr. Fonseca. Chair. Mr. Governor, Mr. Macklem, I will do the same as I did earlier, quoting another economist, not at all of the same school of thinking as Joseph Stiglitz. This is Mohamed El Akhyam, published on the 28th of February last. He is strongly criticizing the management of inflation by the Fed. So I quote him at the end of his article. The Fed has expressed a number of different approaches about the strategy about reducing the interest rates. So there being no appropriate guidance, the market has foreseen a 7 or 8% interest raise. Some Wall Street analysts say it might go up by 10%, 50 basis points higher when the Feds met in mid-March. Others have said that it's become a matter of great urgency. So I'd like to know what you think of that. I'm not sure I actually understood your question. You mean the people have inflation expectations that don't align with those of the Feds? Is that it? Well, to begin with, he is criticizing the Fed, saying that that organization hasn't correctly taken into account what a big a problem inflation would be. But the first part of what I quoted to you, he states that at the Feds, they said publicly a number of different things, different points of view about the strategy they should take to manage rising inflation. Do you agree with that? Well, President, in the States, this was discussed today, and I will leave it really to the Feds to communicate about their own monetary policy. I have enough challenges here in Canada, so I'll focus on inflation in Canada, if you don't mind. Yes, indeed, that sounds wise. However, it seems to me there's some overlap between what takes place there, what the Feds are doing, and what decisions you may be making. When The Economist writes that there might be 7, 8, or even 10% inflation rise in 2022, that's what the Feds might bring in. Is this something you find surprising? Do you think they might, or would you rather not comment? I prefer focusing on our own challenges here in Canada. And Canadian monetary policy, I'm glad to speak to that. Do you foresee 7 to 8% interest rate rise in 2022 in Canada? As I said already today, we do foresee a need to taper off, to bring down the rising interest rates. How quickly? We have decision-making points throughout the year, and at each of those, we will review what we think we need to do to keep inflation within our control range at its target. If rates rise faster, yes, we might need to move faster in a more decisive way. In such circumstances, we would raise interest rates faster. But it is possible that after raising it a few times, the effect of our monetary policy will be felt, and we won't need to move further. We might take a break. We'll see. We'll make these decisions as we go along. That's very clear. Thank you. A final question, a short one. Have you changed your expectation modeling for inflation over the last year, and if so, how? We're always trying to improve our modeling, but we haven't really made any major changes to our modeling approach. What we have done is start using all sorts of new types of data. As I mentioned, we look at a number of different data elements about the labor force. Lately, we're using a lot of data related to supply chains and the bottlenecks in those. During the pandemic, we used all types of new data sources. Thank you.
Marie, we are moving to the NDP, and MP Blakey, you'll be the last questioner.
Thank you, and I'm sorry that our time is coming to a close. There's certainly a number of other things I'd be happy to get your thoughts on. One of them, which I'm going to put out there in case you do want to answer, although I suspect I think I might know what your answer is I am interested for those who are, far more exposed to hikes in the interest rate because either because they just have lower incomes or because they have a higher debt to income ratio. I'm wondering what kinds of fiscal policies might complement rising interest rates in order to try and relieve the pressure on those households who are going to be disproportionately affected by rising interest rates. So I'm putting that out there in case you want to come to that. But I'll ask a second question that I have more optimism about getting an answer to, which is to come back to the question of central bank mandates. Now, in Canada, of course, we just renewed the mandate. Full employment didn't enter into the mandate. We know that some of our other allies are incorporating other things into central bank mandates. I believe New Zealand has incorporated something on housing prices explicitly in their mandate. the United Kingdom has incorporated a kind of green financing or climate change related principle to its mandate. On that last point, I'm wondering what role you believe the Bank of Canada could play in trying to transition Canada away from investment in fossil fuels and other carbon intensive industries, or other ways that the Bank of Canada might help the Canadian economy transition towards a more green and more sustainable model.
Well, with respect to climate change, we do have a mandate at the Bank of Canada to foster a stable and efficient financial system. And a key role of the financial system is to channel savings to productive investments. And as we learned in the last crisis in 08-09, if the financial system didn't happen so much in Canada, but globally, if the financial system becomes unstable, everybody suffers. And so one of the risks to the financial system is that climate risks are mispriced, and the risk, to be frank, is that they're underpriced. And then a reckoning comes, and there is a very rapid repricing of that risk, and that leads to, if that was large, that could even lead to financial stability issues. And then the other part of the job of the financial system is to efficiently allocate capital to its most productive investments. So if you're underpricing climate risk, the risk is you're not going to invest enough in renewable energy or more climate-friendly investments. So as I responded to a previous question, it's very hard. There's so much uncertainty about climate change. It's very hard to make predictions. We have undertaken a study with OSFI and 6 financial institutions to look at scenario analysis. And what comes out of that study, which we published in January, is that there is a lot of adjustment for the Canadian economy to adapt to climate change. And
if I may jump in, I think one of the issues and why the kind of traditional rubric is frustrating for a lot of Canadians who are concerned about the very real threats of the climate crisis is that there just doesn't seem to be the sense of urgency that I think that we have to have, and I think many Canadians believe we have to have in order to try and get this problem under control. And so we continue to see huge investments in the fossil fuel industry, and not enough of that being redirected towards initiatives that would lower our carbon footprint in order to try and follow the advice of the IPCC, for example, to keep warming around 1.5 degrees Celsius. I mean, do you think that incorporating these things more explicitly into a central bank's mandate could help foster a higher sense of urgency, not just in the bank itself, but within the financial sector?
Governor, this will be your final answer for our committee.
I think the elements of climate change there are elements of climate change that relate to the Bank of Canada's mandate, whether it's through a stable and efficient financial system or looking at the implications of climate change for monetary policy. I don't think we need a separate mandate. I think there is value in having a clear price stability mandate, and where climate change has implications for the mandates we have, we will take that very seriously. This is a huge generational challenge, and it's going to take many parts of the system to address it.
Thank you, and thank you, MP Blaikie. And I think I speak on behalf of all members and the clerk and the analysts and staff and interpreters and all of us that are here. We want to thank Governor Macklem and Senior Deputy Governor Rogers for appearing before our committee. I know this is a very busy time for you. We did ask you with short notice to appear before us. We thank you for your testimony and the answers to the many questions. Thank you very much.
It's a pleasure, and it's important. Thank you for having us.
Thank you. Okay, members, look for adjournment. Yep. Okay, we're adjourned. Yeah, I do believe we do have some food coming. I don't know what the timeline is like.